Okay, this video is about capitalization versus expense, and it's kind of a theoretical video. And what I'm doing is trying to convince you that the way we account for long-lived assets is a good way. So you could either capitalize the long-lived asset and depreciate it if it's a finite-lived asset, or you could just expense it as soon as you buy it and never think about it again. So let's take a look. Let's imagine a theoretical scenario. We purchase a long-lived asset, and it's going to cost us $1,500 to purchase it, and the asset will earn us $2,000 each year over the next 2 years. And something you can just think about, so what kind of an asset could this be? Well, imagine it's like you're a magician, and it's supplies for your magical business, okay? So you're buying $1,500 worth of supplies for your magic business, and they'll last 2 years, and you think you'll earn $2,000 each year over the next 2 years using those supplies. So let's talk about two ways we could account for this purchase of $1,500 worth of magic equipment. First, what if we don't use the actual rules? What if we don't capitalize long-lived assets? As soon as we purchase something, we just expense it and never think about it again. So what would our income statement look like under this accounting treatment? Well, here's an income statement for year 1 and year 2. And as I said, in each year we'll have $1,000 and totaling $2,000 over 2 years. Okay, so it's total $2,000 over 2 years, $1,000 evenly each year. How would we treat expense under this methodology? Well, if we just expense everything as we buy it, it'd be $1,500 worth of expense that first year for a net income of negative $500 in year 1. Why is this bad? Well, imagine yourself as an investor in this company, and what you observe in year 1 is a company that loses $500. You might make a bad decision and end the company after 1 year of bad performance. But what will we observe in year 2 is zero expense, because we've already expensed the full cost of the equipment in year 1, and we'll observe $1,000 of net income in year 2 and hope that we didn't make a bad decision after seeing that bad performance in year 1. Okay. So why do we use the accounting treatment that we do? So we capitalize long-lived assets, and we try to allocate their cost to the period in which they earn us revenue. So let's look at the income statement under the rules that we actually use. So we'll set a 2-year useful life for this $1,500 equipment. And so what will we expense in year 1 is just half of the total cost of the equipment, which is $750. And we'll do the same in year 2. So $750 and $750. Well, we're still expensing a total of $1,500. We're just doing it evenly over the 2 years. And you see that this accounting treatment produces a very smooth income stream, in that income in year 1 is very useful at predicting what income will be in the future in year 2. And so this year 1 income statement is a more faithful representation of how profitable our magic business is. And that's just a little theoretical explanation for why we capitalize and depreciate long-lived assets.